Hi, I'm Lisa Berger, and in this module for the Optimum Academy, I will review a few types of trust that you might see during the underwriting process. So trusts are estate planning tools. They transfer assets to beneficiaries and minimize estate taxes. So it protects those assets and it allows for specific instructions on how and when they are distributed to the beneficiaries. It's a pretty efficient way to pass wealth to future generations. And the various types of trust depend on the goals of the grantor. Some commonly seen trusts are revocable living trust, irrevocable life insurance trust, a grantor retained annuity trust, a charitable remainder trust, a qualified personal residence trust, a dynasty trust, bypass or credit shelter trust, and special needs trust. And we're going to review a little bit of each of these. So first we're going to start with a revocable living trust. This is a trust that allows the grantor to maintain control and ownership of assets during their lifetime. And assets in this trust, they are allowed to avoid probate and pass directly to the beneficiaries without going through the probate process. Trusts are flexible, as the grantor can specify how and when assets are distributed. Now, the challenge for life insurance in using a revocable type of a trust is that the grantor can make the changes. They can add or actually remove assets or revoke the trust altogether. The main reason for this is because the ownership of the assets remains with the grantor. It doesn't remain with the beneficiary. Now, the use of trusts is commonly for wealth transfer, but the ownership of those assets, that's really what makes the difference. And for life insurance, because the beneficiary doesn't hold ownership in those assets, it's not an acceptable form of trust to use for considering future inheritance. Now, an irrevocable life insurance trust, usually said as an ILIT, it's designed to own and manage life insurance policies outside the grantor's estate, and it minimizes estate taxes by doing so. Those assets inside the ILIT are protected from the creditors of the beneficiaries, and it ensures that the entire life insurance proceeds are intact for the beneficiaries that are intended on that trust. Now, the control over distribution, the grantor can specify how the proceeds are distributed and managed. And this is usually something that you'll see for the financial needs of beneficiaries or funding specific purposes such as charitable giving or education. And the special part of the irrevocable life insurance trust, the beneficiaries are seen to own the assets in the trust, and that these are irrevocable. It can't be changed like the revocable trust. So this is the desirable type of a trust for inheritance and wealth transfer purposes for life insurance. Now, another acceptable trust for wealth transfer or inheritance is a grantor retained annuity trust. This type of trust allows a grantor to transfer assets to the beneficiaries with reduced gift tax implication. So the grantor retains the right to receive and the grantor receives the right to receive an annuity payment for a specified period. It's a combination of taking those assets and utilizing the tax advantage for gifting, as well as providing an annuity. So the value of the gift to the beneficiaries is determined by subtracting the present value of the annuity payments from the initial value of the assets. And if the assets appreciate more than the IRS assumed interest rate, the excess passes to the beneficiaries tax-free. So this helps to reduce the size of the grantor's taxable estate. And a charitable remainder trust, it provides income for the grantor or other beneficiaries for a specified period of time. And after that period of time ends, the assets that remain are transferred to the designated charity. So for tax benefits, the grantor receives an income tax reduction for the charitable contribution. And the capital gains tax on appreciated assets transferred to the trust can be deferred or even reduced. For philanthropic giving, it allows a grantor to support charitable causes while also providing income for beneficiaries, usually a family member, during their lifetime. A qualified personal residence trust isn't normally seen for life insurance, but it's good to be aware of. It allows the grantor to transfer a personal residence to beneficiaries at a group reduced gift tax value. The grantor retains the right to live in the residence for a specified period of time, and after that time period ends, the ownership of the residence passes to the beneficiaries. This helps to reduce the size of the grantor's taxable estate. A dynasty trust is very commonly seen for generational wealth transfer. It's designed to pass wealth to multiple generations of beneficiaries, and it can last for several generations, potentially being indefinite. That minimizes estate taxes by skipping multiple generations of taxation. And the assets are not subject to estate tax as they pass from one generation to the next. The grantor can specify how and when assets are distributed to the beneficiaries, and the trust can provide for ongoing financial support, education, or other purposes. A bypass trust or credit shelter trust helps to minimize estate taxes. It uses the grantor's estate tax exemption, and assets up to that exemption amount are placed in the trust, which reduces the taxable estate. A common use for this type of trust is to provide income for the surviving spouse while preserving assets for children or other beneficiaries. And those assets in the bypass trust are protected from estate taxes and passed on to future generations. A special needs trust is a great tool to ensure that needs are taken care of well into the future for someone that does have special needs. The assets in the trust are separate from the estate so that the governmental benefits can still be applied. It doesn't disqualify the beneficiary by giving all the assets. It places them in the trust so that that special needs individual can obtain governmental support. The grantor can also specify how the trust assets are going to be used for the beneficiary's care, for their support, as well as their quality of life. So again, this is a very nice protective trust when there are special needs individuals involved. Now, a few final thoughts. When you're looking at a trust, you need to look at who the grantor is, who is actually giving the assets, who the beneficiary is, or who is receiving those assets, where the ownership lies for those assets. Is it revocable or irrevocable? Are they named on the trust agreement? As well as the purpose of the trust matching the arrangement that's been established. Is it something where you want to make sure the family's taken care of with the charity ending at the end? Is it a special needs? Is it generational? All those types of things. So the name of the trust will probably give you a clue. And looking at the trust documents to determine the grantor, the beneficiary, and ownership of the assets and the purpose. Those types of things will keep you in line with making sure that what they're asking for on the application makes sense. And as always, everything with underwriting doesn't make sense. If it doesn't make sense, ask some more questions. And speaking of questions, anything that you have that you would like us to do in other modules, any questions you have about this, please reach out to us. We are happy to do whatever you need us to do at the Optimum Academy. So thanks for taking time to join me.